Hello, future billionaires. Welcome back to another episode of the Invest Like a Billionaire podcast. Today on the podcast, we have something a little bit unique. So, just recently, we hosted a webinar on oil and gas investing. And this is something that we thought was just too good not to share with our podcast listeners. And so, we're actually going to do a two-part series because this was a pretty long webinar and really diving deep into the nuances of oil and gas investing. And so, we brought on a 40-year expert in this space. His name is Jeff Mohajir of Mohajir Energy Advisors. He's been a consultant on billions of dollars of drilling for very large operators, and they've operated 5 of their own funds. And so he's seen everything you can see over the past 40 years and up and down markets and as this landscape has evolved. And so this is something, if you've been following us for a while, that we're very bullish on. We think there's a lot of opportunity in oil and gas investing. And so we really wanted to kind of lay out, this masterclass concept of all the things you got to think about when you're looking at deals in this sector. And so some of the things we cover first and foremost on this first part of the podcast is what's the bigger picture environment? What's the macro environment going on? What's the political environment? What are the economic things going on? And how is it kind of changing the energy landscape? And then we dive really deep into the technical side of it, right? Understanding the nuances of horizontal versus vertical drilling. We talk about different ways and types of investing in oil and gas. Even talk about fracking, right? And then the next part of this, you'll see the kind of final pieces that we talk about, which will include talking about the risk factors and things you got to consider, and then really where we're seeing the opportunities. So a lot of juicy detail here that you're going to want to stay tuned for. So do not tune out and enjoy this masterclass, part 1 on oil and gas investing. This is the Invest Like a Billionaire podcast, where we uncover the alternative investments and strategies that billionaires use to grow wealth. The tools and tactics you'll learn from this podcast will make you a better investor and help you build legacy wealth. Join us as we dive into the world of alternative investments, uncover strategies of the ultra wealthy, discuss economics, and interview successful investors. Looking for passive investments done for you? With Aspen Funds, we help accredited investors that are looking for higher yields and diversification from the stock market. As a passive investor, we do all the work for you, making sure your money is working hard for you in alternative investments. In fact, our team invests alongside you in every deal, so our interests are aligned. We focus on macro-driven alternative investments so your portfolio is best positioned for this economic environment. Get started and download your free economic report today. Hello, everyone. Thanks for coming on today. This is our oil and gas masterclass. Even rhymes. We're super excited to do this today. And the whole kind of topic is a deep dive on oil and gas investing and really how to evaluate energy investments, right? So if you've been tuning into our podcast or listening to any of the content we've been putting out at Aspen Funds, we're very bullish on oil and gas, meaning we're very, believe that the prices have some room to run to the upside. There's a lot of extraneous factors going on that we think support investing in this asset class. And as we've been doing over the past couple of years, we've been seeing a lot more people coming out with different oil and gas opportunities, and they're not all created equal. And so we wanted to bring on our guest today, Jeff Mohajir. We're very excited to have here in person in our office here in Kansas City. And
this
Jeff,
is oil and gas investing. I thought this was a pickleball
the wrong one. Well, Jeff has been in this space for almost 40 years.
40 years, yeah.
Okay. So he's seen it all, been through many, many cycles, and obviously just has a whole lot of experience and wisdom to share with us. So
we're going to be
let's
focusing on making oil and gas investing approachable to investors who haven't done oil and gas before. So a lot of folks in our world have done real estate investing, note investing, other kinds of investing, but oil and gas is one of these scary things that a lot of people have had bad experiences in or have heard about bad experiences. So we're going to dive in and actually look at how to do this right.
Yeah. So before we do that, Jeff, can you give a little bit of your background and just to give people context for, your expertise and
Sure. I went to the University of Kansas, studied geology,
rock chalk,
and got a job right out of school moved to Houston. And so a lot of people call it the Planet Houston. I did a tour in Houston, where a lot of energy folks go. I work for a company called Panhandle Eastern Pipeline that moved from Kansas City right down on Broadway to Westover in Westheimer in Houston. And it was a great experience. It was interstate pipeline. Got a lot of great experience. They moved me very quickly from the geology department into contracts. So I ended up doing a lot of contract work and was there for almost 5 years. My dad had started a consulting firm here in Kansas City with an office in Houston.
And it was energy consulting, right?
Energy consulting, petroleum engineering, geological consulting, geophysical consulting. And his anchor client was a large endowment fund that was wanting to do energy investing. And back in the late 80s, oil prices had crashed, and this fund had put together a mezzanine bank fund. And so we were named the technical or exclusive technical consultant to the fund. So the fund basically made around $400 million in investments. We advised on all of those. Obviously, by making $400 million, we probably looked at over $1 billion worth of investments.
Wow.
And
advised on geology, engineering, all things technical related to this, and valuation.
Technical and economic.
And economic.
Yeah. So we were running all the economic models, doing all the forecast. And, we were very fortunate in the fact that the fund made over a 20% rate of return when they closed. So at that point, we decided, hey, you know what? We're doing a pretty good job for the fund. Why don't we consider doing it for ourselves? So in 1992, we came across a project that we really liked, and we decided to move forward on it. It was in the Rockies. It's about 400 producing oil and natural gas wells that we partnered with a company called KN Energy, who was, interesting enough, was the predecessor to Kinder Morgan, if anybody knows that name.
Sure.
So they're the predecessor to Kinder Morgan. They were our partner, and we went out and we developed probably around 100 to 150 wells in about a 3-year time span. KN sold their interest to a small company called Tom Brown, Inc. out of Midland at the time. This would have been 1997. A person by the name of George W. Bush was on the board of Tom Brown. And he, after they bought us out, he left and ran for governor of Texas. But they since had been sold to Encana, and now they have been sold to Aventiv.
Now, how did they do on your investment?
They did great. I remember in 1997 when we sold, we priced all of our natural gas. It was a very natural gas centric play. We priced all of our natural gas at $2 per MCF. Gas price flat for the life of the property. So this is 50 years, long-lived reserves. And we sold the reserves for roughly about 50 cents per MCF, proved MCF in the ground. And that was 1997.
Wow.
I thought we did very good on it. So in 2003, Tom Brown took our assets, sold to Encana for $3 per MCF in the ground. So they did better. And that actually gave me a great lesson about capital formation and what your motivators are in terms of your divestment strategy and how capital can kind of push you maybe a little sooner rather than later in terms of selling something.
Right. And through the past several decades, you've done, I think, 5 funds, right? And even
actually five different LLCs or investment opportunities is what we really have done. Yes.
And at different points of the market. I mean, the latest one you did was 2020, right? Which seemed like a hard time to be in the space, but is obviously done very well.
Yeah, that we were, again, very blessed. We took advantage of a situation where 2020, everybody knows, April 11th, 2020, oil traded at negative $37 a barrel. So what ended up happening was there were a lot of private equity companies or firms that really got killed. They were looking for ways to rationalize their portfolio companies. We happened to know one of the portfolio companies, and we put together a letter of intent to buy them out. And so we put the letter of intent in place in September with a August 1st, 2020 effective date, and ended up closing on December 29th, 2020. So, yeah, it was, a lot of people at that time thought, energy's dead. Never go above $35 a barrel again. Gas will never go above $2 an MCF again. But obviously, we thought that was a great time to be investing.
Right.
Well, I think before we dive into a lot of the more technical things, I'd love to just set the stage because inevitably, whenever we talk about oil and gas, I just got an email from someone that said, I can't believe you guys are considering this. I mean, just in a couple of years, EVs are going to take over, and oil and gas is going to be irrelevant, right? And so there is this kind of sense and narrative that is being consistently propagated with the mainstream news that oil and gas is yesterday's energy, and why would I be investing in something that's no longer be relevant, right? So I think let's dive in kind of at the big picture here of why does it even make sense to consider this space, and are we going to be around, in a couple of years having this conversation?
Well, I think number one, it's you said it. It's about energy and power, electricity. Obviously, I think we are moving towards an electric or a power-driven economy. But what most people don't think about is how do you generate power?
Right.
I think I've told you the story maybe, and I have a great friend who lives down the street from me, bought one of these beautiful, electric Mustang SUVs, and he came and picked me up, and it's great. And he said, touting some of the green energy. And I told him, I said, I'm a little upset with you. And he said, well, why? And I said, well, you've just increased our carbon footprint on our block. And he said, well, I bought an electric powered car. And I said, well, you realize that the majority of power in Kansas City is generated by coal. So the more you're plugging in your garage, the more coal generation for power there is. And, he said, well, that's too complicated. I can't think about that. But no, that is it. Oil and natural gas, particularly natural gas on the power side, the more electric cars there are, the more batteries there are, it's going to take more natural gas to generate that power.
Yeah.
We've got a few slides here. Do you want to kind of chime in on some of the kind of green energy thoughts?
Yeah. And so green energy, I mean, we're all rooting for green energy, right?
Yeah.
But there's really, a reality check that's needed, according to the EIA. By 2030, existing mines and projects under construction will only be able to produce about half what's needed to satisfy demand for electric vehicle production. So 59 new lithium mines are needed, 38 new cobalt mines, 72 new nickel mines. And it's worth noting that the lithium mines, for instance, it started in the last decade, took an average of 16 years to develop. So, and by the way, those mines all operate on diesel, right? Diesel,
very high
excavators,
yes.
Diesel trucks transporting diesel operated, refineries. And it takes a massive amount of fossil fuels to do that. Go ahead and flip the next slide. They're saying we need about 40 times the lithium production, 40x in the next, let me see, between now and 2040, 40 times more lithium. Well, where are we going to get that?
And this is just to meet kind of the stated goals for
the
electric
EIA
vehicle.
electric demand. And graphite, we need 25x, cobalt 20x, nickel 20x. And not just that, but a lot of time to develop it. Go ahead and do the next slide. So this kind of answers the question, and for anybody that can see this. So if you look at all fuels today of all energy sources right now, 83% are carbon, 83%. It's about a third, coal, natural gas, and oil. But as you pointed out, if you want to move something, a mass of something from one place to another, only liquid petroleum can do that,
That's
right?
correct.
Right now, that's ships, airplanes,
Correct.
uh, trains. They're all running on liquid petroleum products.
Yeah, I always think about this. I always think about, it's a little bit like physics, right? If we live in a global economy, our whole economy, Amazon, is all based on moving products freely around the globe. And the only way to efficiently move mass is through liquefied petroleum.
Yeah. So back to this slide. So 83% of fuels are carbon. So 17% is non-carbon, and that's nuclear, hydro, wind. Wind is 17% of the 17%. So it's just really not much. And we've been trying to decarbonize really since the 1970s. So 50 years and we've gotten 17%. While we're all rooting for it, the truth is, green energy just is not ready to carry the load of what we have.
And I think going back to the kind of mineral exploration needed for lithium and all these other ones, in the U.S., there hasn't been a new lithium mine permitted for how long, right? And it's just that we're not making the steps needed to actually increase the production, right? It's
Right.
magically going to appear somehow.
Right. So it's a lot of wishful thinking. The truth is we are a carbon-based economy, and we will be for the foreseeable future. And there's a lot of hope out there, and fission or fusion, but it's not close. The world is walked away from nuclear, which I think is a great alternative. Even new nuclear is very safe and very cost effective and very clean. There's new generation of nuclear technologies. Fission. Fusion is a long ways away. There's nothing even close. So yeah.
Do you want to comment on kind of some of the ESG narratives that's driven supply down?
Yes. So there was we can talk more about ESG a little bit. But there was, during the end of the Obama recession, I mean, you remember the Obama recession, it's like the economy never quite got going, and energy demand globally just started to plateau. And if you look at the curves, it started to kind of plateau out. Well, the narrative came forth. We've done it. We're post fossil fuels now, correct? And that was great until demand starts creeping up, which we saw, in the post-COVID era. But what happened is this narrative, well, why would you want to invest in a dead business, right? It has no future. And so what happened is global energy investment decreased by 55% in new production, generating new fossil fuel production. And it's one of these things that's so unpopular. If you say you're drilling for oil, you almost have to put a paper bag over your head, right? Especially, if you're on the coast or something, or in the wrong crowds,
Yes.
and you're destroying the planet. And so that just, people exited the market, and meanwhile, a lot of our politicians, John Kerry, has been going around and trying to make sure that there was no access to capital for any of the fossil fuel producers. So literally you couldn't get bank loans, you couldn't get credit, and really undermining this. And the problem with that, okay, so it's dropped by 55% investment. The problem is that global energy production is decreasing about 5 to 7% per year because of depletion, meaning you're pulling the oil out, your production is dropping. We need 5 million barrels a day of new production coming online every year just to maintain production levels. So the problem is, if you don't invest, you don't get that. So what we're seeing is you simply can't fix it. 7 years of underinvestment is going to take 7 years of overinvestment. After 7 years, we will see production begin to increase. But the problem is there's not a lot of marginal production. So as soon as we see demand, our view is we're going to see energy prices rise. And right now, because of China's slowness and a few other things, we're not seeing demand hitting yet.
Yeah, and I think kind of playing to that thought of the demand side of it, most estimates are predicting even by 2030 that demand for oil and gas is going to be at least the same, if not increase, just because we can't hit these goals as fast as they want us to kind of convert to the renewable energies. And it's, beyond 2030, it's probably, still pretty aggressive on how quickly we can
Right.
adopt some of these technologies. So you got a decreasing supply curve, you got at least consistent, if not growing demand. And that usually only does one thing to the market.
Right.
And that's kind of what's interesting here. So well, I'd love to kind of, parlay that conversation into just from your experience being in the space for a long time. What are you seeing right now as, what's kind of happening in the landscape, right? Because you mentioned earlier in 2020, when oil prices went negative for a day, and a lot of these, companies that were investing were maybe a little bit over leveraged, and got wiped out. It's kind of changed the appetite a little bit. It's kind of changed the game to where it's the thought process and how you invest is different than a few years ago.
For sure. The investment strategy has completely changed. In my career, the investment strategy for oil and gas, particularly for oil and gas entrepreneurs, had been a value play. It always been sort of a value play. I mean, we have a very capital intensive business. As Bob mentioned, you have somewhere between a 7 to 10%, just a natural reservoir decline, for most reservoirs. You've got a depleting asset that needs to be replaced with new drilling, which is capitally intensive. And so it was always a value play. You buy something, you sprinkle just the right amount of capital into it, and then you sell it to a much larger investment company or oil and gas company for a disproportionate interest rate of return. So
When you're saying value creation, is that through drilling or is that
Value
buying
add.
existing production?
value added through drilling,
through
through,
drilling.
and
Yeah.
you basically are selling the undeveloped locations, the proved undeveloped. So the upside, you're selling the upside,
Right.
because
So you're
you've proved
proving
it
out
out.
the reserves and then you're selling that to the next guy to go drill it.
Very similar to something that you would experience in the .com era. You're basically selling upside. Well, with COVID, and because we had so many capital institutions get hit hard and we're not able to return capital back to limited partners, we have
in the oil and gas space.
in oil and gas space, we have had our industry go from more of a value play to much more of an income play. And it's brought in a discipline where, there was so much capital, and because of interest rates, it was relatively cheap capital
Mhm.
that was getting deployed, that, when prices went down, the private equity, the institutional capital kind of dried up. And then you have, on top of that, the ESG, which you have a lot of the limited partners that might be in a private equity fund, be it an endowment or some kind of other institutional, capital source, just doesn't want to invest in hydrocarbons. So
So people are exiting the market. So capital fled.
capital has fled. It's brought some of a discipline to where, not only do you have that, but then you also have sort of geologically, you've got where we have all of these plays have sort of been figured out. You don't have a land rush, so to speak. So, all of the plays in Texas,
Yeah, meaning
Oklahoma.
the producing basins,
Correct.
they're kind of known quantities.
Correct.
Yeah,
Correct.
yeah.
Correct.
So it's not this wildcat,
Right. Everybody's
know,
chasing, trying
some
to get
dream,
into
right. right?
a new play, and, trying to, figure out how we can get, high returns on our
Right.
capital being
And
deployed.
so as capital has fled, a lot of the big boys have stopped leveraging heavily, right? Capital is there's got much more conservative. They're not putting debt on these things. They're not there's not a lot of capital is far less available today, both in terms of debt and equity, to big boys and little guys
Correct.
in the space. And it's also caused the pricing of oil fields to drop dramatically. When you say it's gone from it's not priced on income. It's not priced like a .com where, hey, we got this great idea. It's worth $1 billion.
Correct.
To now, how much money can you produce cash for me next month? That's what I'm going to pay you on. So prices of these producing assets have dropped precipitously.
Correct. And
They're
investors
on
are,
sale, right?
yeah, the investors are much more concerned with dividends or distributions.
Right.
And
Instead of blue sky,
correct.
hey, it's going to be amazing.
And there's also been kind of a broader just approach to not oversupplying the market too, because part of what happened in kind of COVID era, and obviously demand, but then there was a lot of just pump, 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 pump. And you've kind of said that not just discipline on the capital structure side of, having lower leverage, but also a sense of, hey, let's not flood the market because we kind of like these prices a little bit where they're at, right? We don't want to get back to $20, $30 oil.
Correct. And, there's this old adage, right? The best cure for high prices are high prices.
Right.
The best cure for low prices are low prices.
Right.
And so you have this idea that capital kind of is efficient and it comes into a market when it's needed. At the same time, we have oil and gas companies who, got really kicked, during COVID. Prices have come back up in 2021, 2022. And so a lot of them figured out their bank loans, and their balance sheets are in good shape.
Right.
And so now they're saying to themselves, look, for us, it's better to maintain, instead of having 12 rigs running and trying to bring a bunch of supply on, it might be better for us to only have 4 or 5 rigs running.
Right. No one's chasing the upside as much anymore. And you're seeing this when prices hit $120 a barrel, not too long back, you didn't see a lot of new production coming online. People are like,
Not only did you not see a lot of new production, you didn't see a lot of new capital because these investment allocators, whether it be at a pension or at a, endowment or a private equity, they don't want to be the one to have to write down their investment 30% again, like they did in 2020.
Right. And this was kind of, you're talking about the COVID crash. There was a crash before this, was around the 2016 timeframe, right? So much of the industry, there's bankruptcies left and
Correct.
right. And it was people chasing the kind of the fracking revolution, which really, and the whole horizontal and fracking technology. People don't realize how new that is.
New, relatively new, yes.
And so all these these basins got massively developed. And it was a lot of blue sky, a lot of .com type
Correct.
emotion or exuberance, right? And then when the crash came around 2016, just bankruptcies galore in the industry. So it's kind of the second major hand slap on the industry. And now the industry is just like, we're not taking any risk here.
Right. Right. I think it has brought in a discipline. And so
Right.
you've seen that from, it was an overdevelopment in some of these plays to now just the right amount of development. And a lot of companies
Or underdevelopment.
A lot of companies at the time in 2016 were trying to drill their way out of
Right.
a bad situation.
So
And that's
prices
very
are
hard.
collapsing. You're
Correct.
drilling faster and faster
Correct.
to earn less and less.
Correct.
And, and then
Yeah,
the
it
bottom
was sort of
fell
the
out.
perfect storm at that
Yeah,
time.
it was. And so a lot of discipline is coming in, but what's happened because of this, because capital has fled, and because of ESG, ESG people don't realize there's a lot of activist investors that have taken
Mhm.
over boards of the majors, and they're focusing on renewables instead of oil and gas development, which is great for renewables, but it's not very good for oil and gas, and creating again a big undersupply.
And a
That's
lot
true.
of
And the other thing that's important is you're right about the majors, but really when you think about oil and gas development and production in our country, it's what we call the independent oil and gas companies that really are the ones that go out and take risk in new areas or do a lot of the drilling,
Right.
do a lot of the geology. And those companies, they're not Exxon, they're not Chevron. They have to get access to capital, whether it be through
Right.
institutions, private equity, or banks. And that is very hard for them. So they're
Right.
not driving development.
Okay, so
Yeah, let's
shift to the
shift kind
technical?
of the technical here. So we've, a lot of the people on this webinar are probably thinking, I've seen some things come around. I've heard of, vertical versus horizontal. I've heard of fracking. I've heard, all these different terms, but let's just kind of break down. If you kind of mentioned earlier on the oil and gas geology and
just
kind of how
start with geology. How does oil and gas work? So, and think about a real estate investor. We don't know much about this kind of thing. So, give us, you know, give us your entire degree in 5 minutes or less.
Well, when I think about geology, and it always does sort of start with the rock, because you're producing oil or natural gas out of rock sediments. And rock is obviously subsurface. So that's one of the things to always kind of think about. We think about real estate investing, we think about something on the surface. One of the hard pieces of oil and gas is, as opposed to like coal, you mine coal or you mine minerals, and you can put the minerals up on the surface in the warehouse next door. Well, with oil and natural gas, it's typically, you're not storing it. I mean, the storage is in the ground,
Right.
and now you're trying to figure out just how much is down there. Will it produce economically at given commodity prices, at given expenses? And so it can be anywhere from 3,000-4,000 feet. Actually, surprisingly enough, the natural gas industry, particularly for natural gas interstate pipelines, started not too far away from this spot out in Lewisburg, Kansas, where they were producing natural gas out of coal mines. Pretty shallow, 1,000 feet, 1,500 feet. And they were collecting this natural gas and then selling it to end users. And that's really kind of how the mid-continent interstate pipeline business started. So it goes down, somewhere anywhere between, 1,000 feet all the way down to, 30,000 feet. And then obviously
So
the
that'd be
offshore
6
stuff.
miles.
Yeah. And it can get the way that our industry drills is engineering feat on how they can bring oil and natural gas to the surface. And then we've had this major, new technology come through for horizontal drilling.
Okay, but
and
before
horizontal
we get to that,
completions.
so I think a lot of people think about an oil and gas or an oil well. You drill a hole and there's this giant lake of oil down there, and you hit it, and then it gushers up, and you sell it. It's not really like that, right?
No, it's a pond. It's not really like, the best analogy I can give you is that, you've got a cup here and you put a straw in it, and each reservoir, each straw has a different size cup. And the way that you suck the oil or natural gas out, the pressure that you're using, that's kind of what we're trying to figure out, is just how much is there.
But it's not a reservoir in the true sense of the most people would think about it. It's really just oily rock.
It's oil. Well, yeah, it's not the Clampets where you go out shooting and oil comes popping out of the ground. That's typically not how it works.
And so I think a lot of the traditional wells that were drilled early on in the 50s and 60s and stuff, they were certain geological formations. There were salt caps and other things that really very unique things, are very rare, very difficult to find, and that had a lot of oil. A lot of that stuff's played out. And what's happening now, and you correct me if I'm wrong, but my understanding is it's in shale plays. So these are very tight plays. So the rock is very tight. It's not very porous. So the way you get oil out is the rock has to be porous, right? It has to, think of a sandstone or a sand, where the oil can move through the rock.
That's permeability. Yes, that's permeability.
Permeability. And if the rock's tight, it can't move. And it's also laid out, in these, for example, the shale plays, it's laid out in sedimentary layers. So it's this giant layer. Like you go out to the Grand Canyon, you see layers of red and then layers of white, and it's layers of oil-bearing rock that are horizontal and for hundreds of square miles. Yeah. And then there's another layer below that that's a different kind of oil-bearing rock that's hundreds of square miles, and maybe it's 10 feet deep or 20 feet deep in other places, but it's very predictable, right, where it is.
Correct. And that's where the new technology came into play for horizontal drilling. So what happened was, vertical drilling, obviously a lot of wells have been drilled.
So vertical drilling, you just drill straight down, and whatever happens, happens.
You've got a target, you go down, you're drilling vertically into it. You have a target reservoir. And what happened was and when you're drilling, they have geologists on site and they get these, what they call shows as they're drilling. They'd be oil or natural gas. And a lot of them, as these guys were drilling through shales, they would get these great shows, but they could never get them to produce.
Right.
And so people would scratch their head. Gosh, I'm drilling through here and I get these great shows. I can't get this thing to produce. I'm always producing below it or I'm producing above it until, and I don't know his name, but from what I understand, it was a young completion engineer at in the Barnett Shale that worked for Mitchell Oil and Gas that broke the code on how to drill horizontally into a shale. And you can imagine, I mean, you're drilling and then you're turning the pipe 90 degrees into this zone, and then you're trying to figure out a way, and you have to keep it straight, because if you undulate, you're going to create P-traps to where you can't really produce past it, right? It's like your kitchen sink.
Sure.
You can't get the gas or the oil past it. So then you have to find a way to complete it to where you can actually coax the oil or the natural gas out of that reservoir.
So literally vertical, we've drilled some vertical wells, and it costs, for a mile down or so, $250,000 to drill, and then another $500,000-ish to complete it, meaning completing it means putting the pumping stuff on top and the piping and all that stuff. Casing, yeah. So now horizontal is a completely different animal. So it's maybe, $5 to $10 million per drill, right? And so these things can go miles and miles and miles. So they'll maybe go a mile down, and then they'll go
sometimes 3 miles out
horizontally.
Yes.
And you can drill this way horizontally, then you can go drill this way horizontally,
Correct.
then this way. So you can kind of hit all the points of the compass from one single location, right?
Yeah, which is great. What's great about that is, we think about, we had, we had vertical wells. We might have, on one section, 640 acres, we might have something like 10 or 15 vertical wells on that section. Now, with horizontal drilling, we have one well.
One well
can drain the same amount, and you can imagine there's less issues with operations, and there's probably less capital.
Okay. And talk about the drilling risk, because I mean, I'm a geologist enough to know that this stuff is in layers, and if the layers are predictable in their oil-bearing nature and their nature, that really there's not a lot of ways to miss in a horizontal well.
There's not a lot of ways, and I think there's always, we talk about drilling, we talk about dry holes, and a geologist will come up, he'll draw some lines on a map and say, this is, where I think the reservoir is 5,000 feet below the surface. And you drill down there and you say, wow, we're getting some shows. There looks like there's oil or natural gas down there. And now I've got to complete it. And this is where the engineering comes into play. And quite frankly, in any oil and gas investment, I know we might talk about risk in a little bit, but this is mechanical risk in being able to complete the well in the right fashion to be able to get the oil and gas come out. So while you might have geologically a well that hit, if you don't complete it right, you might have it might be a geologic well. It might not be an economic well.
Back to the risk. So if you do complete it well, the horizontal wells have a very high success rate, right? Of hitting economic.
Now they do.
Yes.
Because in so many of these plays, going from 2008
the geology is
through
so
2016, so much of the risk has been taken out. For an example, in one of the areas in Oklahoma, you might have when you put together a drilling unit, you might consider putting what we call a parent well will be drilled, and then they'll drill it horizontally, complete it, and oh man, that looks good. A geologist or an engineer might come in and say, I can put 11 more of those out here. And he drills 11 more. And you can imagine it, $10 or $15 million a well. That's a lot of capital. Well, he starts to find out on the 6th or 7th well, it's starting to interfere. I'm stealing production from my parent. So these children wells are taking production from the parent well. And so what we found out over time is that, okay, while you might drill a parent well, you've confirmed what you thought geologically and engineering wise. Instead of having 12 children, you might only need 5 or 6 children. And that is just a good way of preserving capital.
So bottom line is a lot of the risk has just been taken out of this. Now,
correct.
Now talk about fracking. So fracking is another of these things that is just this energizes so many people, but I think very few people understand it. So talk about fracking.
Yes. Fracking's been around since probably the 30s or 40s, quite frankly. And
I didn't know that.
Yeah, we've been fracking wells in this country and around the world for a long time.
So
and again, it's basically after you drill, you talk about permeability, and sometimes you have natural permeability in a reservoir to where the oil and natural gas will just come freely. As you're drilling, you put steel casing down the hole, right? And then you have to perforate with, little bullet holes. You basically send a little gun down there. It perforates the steel casing. You're shooting bullet holes into the steel casing. And that's going to allow the reservoir, the oil and gas in the reservoir to seep into the steel casing. Then you're producing it up to the surface. Sometimes, depending on the reservoir pressure, the reservoir will do it on its own. Other times, as I mentioned before, you have to coax it out. And one of the ways we coax it out is by fracking. And the way that you frack is after you've perforated, you'll go in at high pressure, sometimes temperature, and you will take water and some sand, and you will push it out into those perforations to kind of create, quote, fractures.
So you pressurize the rock,
correct,
to get it to crack.
And you have sand. And you have water, and it's not.
So the sand goes into the cracks to kind of keep them open,
to keep the fractures or the fissures open, so that the oil and gas can.
And so it increases permeability and allows, and this is really what unlocked a lot of the shales that were very, very tight. They didn't have high porosity, and you couldn't produce much.
Correct.
So with new fracking techniques, we're able to produce it. Okay, so what's the bad rap against fracking? Is it really destroying our
the bad rap is
aquifers?
The bad rap is that the what they're mixing in with the sand and the water is some kind of chemical that, is detrimental. And you get a lot of these oil and gas groups that will go out and say, oh, well, that it gets into the aquifer. And typically, most oil and gas companies spend a lot of time trying to protect aquifers. They put a lot of casing in place. They make sure that, when they frack, there's typically a rock that will help from having the fracture go up into the aquifer. And a lot of times it's, as you mentioned, a mile or 2 miles below the aquifer.
Right. So people don't realize the aquifers are not deep.
No, they're like 300 feet or
the aquifers,
500 feet.
They're really on the surface.
Correct.
And where most of the drilling is going is far, far below, maybe even a mile below.
Right. So we spend a lot of time trying to protect that.
The oil and gas and the water are already in the same vertical space there anyhow, right?
That's right.
So
And there's always natural fractures.
There's some bad actors doing fracking, but it can be done responsibly.
All right. Well, that's the first part of this masterclass of oil and gas investing. We have part 2 coming for you here really soon. And so stay tuned. We're going to jump right back into the technical considerations to be aware of when you're evaluating oil and gas. Thanks so much, and stay tuned for part 2.